I be getting to the money. Everybody mad. I think I'm getting too much money.
Hey everybody, I'm Jayden Hollywood, financial life coach here in Atlanta, Georgia. And this is the first video of our series, Black Married Fly on a What? A Budget. Being a financial life coach, most of my clientele happens to be married couples. And I often get the question, how does the new tax law affect me? So I figured I'd do a video with 3 of the biggest changes that I've noticed in my married couple clientele. So let's get into it. The first big change that I want to talk about is the child tax credit. Previously to 2018, the child tax credit was only $1,000 per child. But now, starting with the 2018 tax year, you can get a tax credit up to $2,000 per child. Now, we've all heard, I need to have some kids so I can get a tax credit. I'm not telling you to do that, but if that's an incentive for you to have some bundles of joy, then by all means do so. But I didn't tell you to have kids, and I'm not babysitting, just a disclaimer. For the child tax credit, a lot of people are confused as to the difference between what is a tax credit versus the deduction. So I'm going to simplify it for you. When you're doing your tax return, you start with your income, and then from your income, deductions, whether that be standard or itemized, is subtracted. And that will give you your taxable income. From your taxable income, your tax liability is computed. And from your tax liability, credits are subtracted to then get you your tax due or your tax refund. Now, clearly, as you can see here from this very simplified equation that I've given you, credits are more of a benefit to taxpayers than deductions are. So that extra $1,000 per child is quite a big deal for a lot of people, whether you're married or not, but a lot of married people have kids, so yeah. Next, I want to talk about the standard deduction versus the itemized deduction. So previous to 2018, the standard deduction for a married couple was $12,700. For the 2018 tax year, the standard deduction for a married couple filing jointly is $24,000. Another change with the itemized deductions is how much of your taxes paid in a tax year you can claim as a deduction. So previous to 2018, a married couple would, this is just an easy example of a number of itemized deductions a married couple can have. State tax, and this is state tax withholding from your W-2, real estate tax of $4,000, mortgage interest of $3,000, charity of $1,000, bringing us to a grand total of $20,000. So this example would work previous to 2018. But now in the 2018, you can only deduct up to $10,000 in taxes paid. So what does that mean? That means this number right here, this 12,000 plus the 4,000 is now going to be capped at 10,000. So you're losing essentially 6,000 from your itemized deductions. So now this couple will only be able to itemize $14,000. So with that being said, $14,000 is much less than $24,000. So this couple would choose to use the standard deduction rather than the itemized deduction. So the argument previously, people would tell you, you should buy a house because it's a tax deduction. Buy a house, it's great for your taxes. But now a lot of people, a lot of married couples that are looking into buying a home for the first time, they're looking into growing their family, they're reconsidering home purchasing versus renting because they're starting to notice that home ownership isn't that much of a benefit to them anymore. The last change I want to talk about is the treatment of unreimbursed employee expenses. Prior to 2018, taxpayers who incurred expenses for their employer, such as home office expenses, travel, meals in order to bring in new clients, all of those expenses were put on Form 2106, which then flowed to Schedule A, where all your itemized deductions are. Now, the expenses that are on Form 2106, they're subject to a 2% threshold, meaning all of the deductions must be above 2% of your income in order to deduct any of them at all. Now, with the new tax law, all of the deductions that were subject to the 2% income threshold we're not using anymore. So employees that have those expenses, unfortunately, won't get the federal tax deduction. The good thing is that the government has introduced what's called a QBI deduction. QBI stands for Qualified Business Income Deduction. So what that means is that if you meet certain requirements, you can deduct up to 20% of your business income on your tax return. I'm talking about your net business income, which is a huge deal for business owners. So what I'm suggesting a lot of my clients do is to look into what skills they have and consider starting a small business, even if it's a home-based business. You don't necessarily have to start a store, but start a business that you can do in addition to your 9 to 5. Because I'm all about making money moves. And to learn more about me, you can head over to www.letsmakemoneymoves.com. Until next time.
I be getting to the money.